Welcome to the daily update, where I'll go over the action in the market for Monday, July 15th, and then we'll see how things look for Tuesday, July 16th. Had another up day, but it's looking a bit concerning, both in Friday session and in Monday session, to see strength coming on earlier in the day. That's healthy. And we're still seeing the broad market show some improvement, and even some internals inside the S&P 500 are improving. But then we're seeing this late day weakness, this actual selling, and there's no real late day bounce. Some of our smart money indicators are showing some weakness as well. So we want to be aware of that. Things are positive on all time fronts, and we even closed higher with the S&P 500, but I'm noticing some things that are a little bit concerning right now. Before I get into the charts and the analysis, I do have a thing called the SPXInvesting Program. If you're interested in learning more about that, there are links that will take you to some videos as well as to the website. Here's an email address where you can contact me. It's wide open right now, but I will be locking it down in August. Also, I put out a number of different videos each week. The daily video is the real foundation of my analysis and commentary. All of the other videos that are weekly, they just feed into the daily video. So if you're seeing these videos for the first time, or maybe you're watching one of these other videos and this is bringing you over to this daily video, that's really the intention and how you're going to get the most from the insight and analysis that I provide. Okay, let's go back and talk about what happened and then look at some charts. We had a gap higher open. The futures were pretty strong and were drifting higher as things started to open on Monday. We got above R1 at 56.50, which again is kind of one of those round numbers, and it's always interesting how these pivot points line up quite often to these round numbers. But then we hit resistance. And what's interesting is there are a couple of pivot points from Friday and Thursday last week. That's where we topped out. So sometimes these pivot points can still come back into play even after that day itself has passed. As the day went on, we fell back below R1. We did find some short-term support at a pivot point from Friday. So again, we're going back. Now, you might hear of a thing called program trading and all these algorithms and quants and where computers are doing all the trading. Yeah, that's true. And anywhere from 60 to 90% of the daily volume comes from not people. It's coming from computers that have been programmed to do these things. And all these numbers that I go through, they're programmed into those computers. There's really nothing new out there. Somebody thinks they have some algorithm that's going to break the code and be the holy grail to everything. That's just not true. If they do find something, it will typically last for a period of time and then no longer work. What I try to implement in my analysis are things that really have stood the test of time. So the numbers being in there from these previous pivot points, that's not a surprise. Computers were picking that stuff up. And when everything comes together, they were told to either buy or sell. We ended up closing slightly above the pivot point after we got down to that level at 56.20. We were up 0.28%. We dropped to below average with volume. Not a real surprise. We're in the middle of July right now. We're coming out of a period of historical positive seasonality. We're coming into options expiration week where sometimes we see some negative seasonality during this time. And so you might have some folks kind of laying back a little bit, or they're sitting on a beach somewhere. We are positive with our technicals. We're still looking good there, but there's some things that we go through, and I'll be pointing those out as I go through the charts. And the inflation and interest rate scenario could be starting to change. The market is really counting on there being a rate cut in September. The small caps are still seeing more follow through to the upside. The mid caps are also improving. And that could mean that we're shifting to the next phase of this whole stock market cycle. And if you think that small caps going in the lead is a bad thing, well, go back to the bounce up out of 2020 and in through 2021. The small caps were doing really well back then. We were in a zero interest rate environment at that time. Now we're possibly in an interest rate lowering environment, which could help the small caps and end up giving some really good support to stocks and the S&P itself. The geopolitical concerns, of course, everything that's going around the news right now is what happened on Saturday with the attempted assassination of Donald Trump. Then we have the Republican National Convention that will be going throughout the week, and it probably won't have much of an impact. In fact, if anything, it had a positive impact on stocks on Monday. The futures, I was watching those on Sunday right as they were opening, and there wasn't any real downward move from that. And then they just kept drifting higher as we got closer to the open on Monday. So these things, now, if the situation had been different and something worse had happened than what already did happen, yeah, there might be a different scenario that is playing out here. But based on the way things have transpired, it really didn't have much of an impact. And if it did, it was probably more of a positive impact. But we want to keep an eye on all these things. There's also wars going on between Russia and Ukraine and in the Middle East, and all the things going on in Europe, especially in France with their elections and some unrest that's happening there. So we just tune into these things, not so much to, oh, good, oh, bad. We just, okay, this is what's going on. Will that have an impact on the stock market? Some comments. The Dow finally confirmed what we've been seeing in some of the other indexes. Now, it set all-time highs earlier, but it had been lagging behind. But it did set a new all-time high in Monday's session, and small caps are still continuing to do well. We saw banks getting hit on Friday. Well, they had pretty solid gains on Monday. Both the banking ETF that we follow and the financial sector, they both had solid gains. Our short-term list, a little bit shorter, but still things that we're keeping an eye on here. With the short-term ADX indicator, we're getting pretty extreme there. The Williams percentar, the CCI 14 and 20, the stochastics, and the short-term RSI. And these can stay this way when we're in a solid positive environment. When we really take note of this is when we see some kind of a counter trend move. This is not a counter trend move. This is a primary trend move that we're going through right now. A counter trend move now would be we're in a longer term uptrend and we do decline and pull back just enough to make the perma bears happy. That's about the time when we probably have hit a bottom, and that would be a counter trend move that would then bounce back up from there. That's kind of just something to keep your mind around if we do start to see some weakness. In the intermediate term, we also have the ADX chart that's looking pretty extreme. The accumulation distribution is measured by the boom indicator. It's still looking rather extreme, even though we're seeing some potential weakness in that area now with our smart money indicators. The standard deviation, we're still up in that +3 channel. Even though it declined a little bit, the McClellan oscillator for the S&P is still extreme. The Sean trend meter, we're still kind of far away from the 50-period moving average. And I believe I should have put the 20-period moving average here on the short-term list. And then the RSI more intermediate term that's based on 14 periods. The long term, we're still looking kind of extreme with the 200-period moving average as well. And then here's the scenario. It really hasn't changed that much. The market is even getting more convinced that there will be a rate cut in September. Now, if things start to develop to put that into doubt, that could really pressure stocks because there's a lot of assumptions that are being made right now. The dollar was up and interest rates were also up. This could have been some of the reason that stocks were under pressure, but right at the open, interest rates were up and stocks started to go up from the beginning. So it didn't have any real initial impact, but later in the day, we climbed to 4.23% by the time we got to the close for the 10-year yield, where we had been at 4.19% after Friday. We're still inverted with those bloody yield curves, and we have been for a couple years now. Sentiment still ticked up. We're at 62, where it had been at 56, and we are still in a confirmed trend. We're getting a little nervous because some of these lines, at least for the ADX and the moving averages, they're getting pretty extreme. But we've seen an up day on Friday and an up day on Monday, and the green line's still going down. That's another little bit of a concern there. With the up day, again, our bias is positive, and then the last number of days taken together. We got hit pretty hard last Thursday, but other than that, the market has maintained a pretty positive stance as it applies to the S&P 500. We only had the New York Fed Empire State Manufacturing. It came in at minus 6.6. They expected it to be at minus 6. Last time it was at minus 6. So here is a chart where it's showing some improvement, but it's still negative for the New York area. And here's some Isabel Net blog charts. It's kind of interesting. This chart was actually put out about July 10th. And it said July 11th could be an extremely good day for the bulls. Well, that was last Thursday, and that's when we had the down day. So you can't always take these blanket statements. Now, there should have been a nice little rally. We saw a little up thrust at the beginning last Thursday, but it didn't last very long. And then we spent the rest of the day coming back down. But under the surface, that's when we really started to notice some of the improvement across other stocks in the S&P 500 and across the broad market. So taking this, when we have these green little dots on here, diamonds, I guess they are, that usually, sometimes it can mean that we see some downward move. My God, we thought we had bottomed back in 2008, only to finally bottom in 2009. But sometimes these do mark bottoms, or at least a continuation of an upward move. And looking on a world basis, what is sentiment looking like? Getting rather extreme on the euphoria scale. And then this is actually came out before Saturday, because this was dated July 11th, so it was last Thursday. And this is the prediction based on probabilities of who's going to win the election. And if you're a Trump supporter, okay, you're probably pretty happy right now. And if you're a Biden supporter, you're probably not very happy. And even the whole Democratic Party itself has been trailing off here. And I'm not saying that to make any kind of a political statement at all. That's another realm than what we deal with here. But we are seeing quite a bit of a shift. And it seems like it's even shifting more after what happened over the weekend. I think a lot of questions are going to be asked about, okay, what's really going on here, and seeing if any answers can actually be found. And looking at the financial conditions, we are loosening now. It is dropping off a little bit, and that can be more positive for the markets. Large cap growth is at its highest level against small cap value since 2000. Well, we're seeing that starting to come down, and I have some charts to show where, yeah, it's large caps have been doing really well, but lately it's been pulling back. And then we look at the year-over-year inflation. This is what in the Atlanta Fed, the Cleveland, and core CPI and PPI. This is basically what they're projecting inflation to be, but we're still above this elusive dash line, which is the 2% level. And then the proportion of companies that beat on earnings, they rose in the first quarter, and it's well above the historical average. So we're just trying to compare, okay, what happened back when they started to report their first quarter earnings, now that we're going to be getting their second quarter earnings, and they're projecting that things look well. And Edward Yardeni, one of the few economists that I actually respect, he sees earnings as being rather positive. And a week ago on the website, I actually did a video about that, just showing that based on some monthly charts, the earnings projections as of right now are looking pretty solid. And then a few charts on Twitter. And I'm glad to know that this is Mark Ungewitter. Okay, I don't know if I'm saying his name right, but he's somebody I like to follow on Twitter. I'm not the only one who does typos. Okay, ADT is evasers, advancers plus decliners. Okay, so yeah, other people who are also pretty well respected in their field also can make typos, which I'm known for doing quite often here. But this just says when it gets above 74% for 3 consecutive trading sessions, and it's above its 200-day moving average, that tends to portend to good things looking forward from here. Then JP Morgan, Jamie Dimon, and I don't know why people listen to him. When he says something, this is like old news to us, things that we've been watching for quite a while now. But because he's the CEO of the biggest bank, and because when he talks, people listen, and they seem to put some interest in it, we've known this headline for months, if not years now, ever since the Fed started raising rates. He warns that inflation and interest rates may stay higher. Well, that's why the Fed hasn't lowered rates. That's why they're keeping them higher for longer. So you're not getting anything new out of this headline. And if you are looking at this headline and making a conclusion based on that, you might want to really focus on how you're getting your information. Also, the trading days from the first Fed cut. If we do get a Fed cut in September, now there's two sides to this whole thing. you have to look at the context. Why would the Fed cut rates in September? Are they cutting rates because inflation is coming down and they want to see more economic growth in the US economy? That would be positive, and stocks can go up from there. And I have charts that back that up. Now, what's the other side of the context? It could be because bad things are happening in the US economy and the Fed is cutting rates to try to stimulate the economy because it's falling apart at that point. And that's kind of what's being shown right here, that a lot of times when the Fed does come in and cut rates, going out into the future, we tend to see declines after that. But you can also bring up a different chart here and make the exact opposite case. And big short investor Steve Esman says shorting current market would be insanity. Well, that would be nice to have known this about 3 weeks ago. But again, these are one of these headlines that people latch onto, and they're pretty much useless. And you need to look at the charts. You need to see what's already developing, because the time people see something like this, it's too late. I'm seeing some things that, and I'm not saying things are going to turn negative, but there are some things that are causing some real concern right now with this late day selling and the fact that we're pretty overextended to the upside. And now we see something like this. And so somebody's going to go, well, this guy must automatically know what he's talking about, so I'm going to go in and buy. And they end up doing it at just the wrong time. Now, I don't know if it's going to play out that way, but this is why most people that listen to other people to get their insight as to what's going on in the market, and they do it in a mass media type of fashion, why they're wrong. And then they think the stock market's rigged and it's only the rich getting richer and the poor getting poorer. Yeah, because the information sources are just not there. Okay, this is kind of interesting. And I'd never heard of this guy because I just don't pay attention to these people. Marko Kolanovic, okay, apparently he's from Croatia. He was considered to be the Gandalf of market forecasting. Well, back at the lows in late 2022, he said, man, we're just going to keep going down. And a lot of people were saying that. It wasn't just this guy. And there was a case to be made that things were going to go lower than they were even going. I wasn't saying that. I was seeing a real bottoming process. And if you go back and watch my videos from that time, you'll see what I was seeing and what I was analyzing. Well, since this guy's a professional. He's supposed to be a rock star with this stuff. He's Gandalf, for heaven's sake, when it comes to seeing the market. Well, this is what has happened since he made that bearish call. Well, as of July 5th, he's no longer employed there. And it's kind of interesting. This is JP Morgan Chase, okay? We just looked at their CEO back here, JP Morgan Chase's CEO. Why are people listening to these guys? Because these folks just, it's just, okay. All right. Anyway, let's go back and talk about what happened. This is the concern that I'm seeing here. Or we came up on Friday, we're looking really good, setting a new intraday all-time high, and then boom, we saw. Now this is a little bit more acceptable because each one of these bars is 10 minutes, 10, 20, 30. So the last 30 minutes, we saw some selling. Okay, we went out, set another new intraday all-time high. Notice these dashed lines, which may be a little bit hard to see. These are pivot points from Friday and Thursday last week. And that's where we topped out. And these lines were really close to each other. Now, could it be just a coincidence? Of course. But when you look at a chart like this and you're seeing lines and stopping where there's really no lines that we're hitting on today's chart, then I go back and look at other potential areas. And this is what I saw. The concern that I'm seeing here is we have a nice, real strong upward move to make things look good right off the bat. And then we see some selling. We tried to bounce up. We came back up to this moving average, hit that, and then came down to the daily pivot. But then we did close up off of the daily pivot. So it was still a positive day. But to see this selling into strength that now has occurred for 2 days is a bit of a concern. Intraday, where we were looking okay, we pretty much shot up when the futures, when the futures were pretty much flat. And then we saw a real improvement as we got closer to the open. And then here's the intraday action. We're up a little bit again in the initial overnight session. Then we're seeing a shift here. where large cap growth is not necessarily outperforming large cap value intraday. Where it had been, the blue line was above the red line. Now we're seeing them more in tandem with each other as we're seeing this shift going on in the market. This is the growth to value ratio intraday for the S&P. Not really seeing any real strength right now. It's not necessarily a warning sign, but it means that the market climate might be shifting a bit here. Our end of day charts. Growth was up a little bit more than value for the large caps, but up less for the mid caps and up more for the small caps. But when we look at our small cap growth to value chart, actually ticked down. The mid caps also ticked down. But if you go back here, you see how we're finally breaking out above this range that we've been in going back to late 2023 for the small caps. We're also finally showing a bit of a breakout, not quite, but it's looking much better now with the mid caps, but their growth to value ratio is not really improving. And then we're actually pretty much flat here with the S&P growth to value ratio. Now, this isn't necessarily negative. It just may mean that the climate is shifting, at least for right now. We look at the growth to value ETFs, where we're still coming down. We're above the rainbow, but now we're starting to come into the upper side of the rainbow as we've seen this decline for the last couple of days. And I've got machines going on outside, and I don't want to go back and start recording this again. So please bear with me. It's very warm where I'm at here. Okay, looking at discretionary, the equal weight, didn't have not much of a change from Friday's session. We actually saw the staples go down. So when we do the ratio, this is improving, but it's not necessarily strength due to discretionary. It's more weakness than what we're seeing right now in staples. Large cap growth did set all-time highs last week, fell back, now showing a bit of an improvement there. This is where we're seeing a potential shift. The Russell 1000, which are large caps, that's kind of equal to the S&P 500. And we do a ratio with the Russell 2000, which is a small cap index, and see how this ratio is coming down. It doesn't mean the large caps are falling apart. It just means that right now we're seeing some strength in the small caps. Then the Wilshire, just coming back and setting another new all-time high, a broad market measure. This is where we're getting a little bit concerned. The ADX is well above 40, and that's a pretty high reading, but it could still go higher than late 2023. We had a very high reading, and it didn't necessarily mean the market fell apart after that. When we saw this high reading, we kind of ticked down lower into the beginning of 2024. What's more concerning to me right now is that the green line continues to come down, even though it is on top. And here's the short term, even a little more extreme, but could still go higher, but the green line still continues to decline. We're below average again here with volume with this oscillator, and we're coming into a period for the NYSE where June, July, August, especially July and August, do often see a real drop off in volume. And we also see that drop off in July and August with the NASDAQ as well. Looking at sentiment, this is the weekly chart we're getting at 88.28. We're still in the extreme camp as far as this is concerned. We're drifting more into the red area, the early parts of the red area, if you want to try to compare it with the chart that we look at each day. And then looking at the insider transactions ratio, a lot of going up here. So this could be turning a little bit more bearish. But when we look at the insider buying ETF, it did spike up, but we're not really breaking out, even though it's still positive. The Ulcer Index is still showing fear is very low. We don't have the latest reading from Investors Intelligence yet. We'll get that later in the week. We did see a pickup in the VIX. It's actually coming above the moving average on the, what am I trying to say here? The line chart. I hear all this noise outside and it kind of messes with my train of thought. And then we're also a bit higher here with the bar chart. And we're seeing a little bit of a pickup here with the VIX of the VIX. They're going back above the moving averages. And the momentum for the VIX tends to be going up now as measured by the MACD. So, and this would be kind of, we're getting into that time now where possibly we're starting to bottom as far as the VIX is concerned, at least when we look at this on a seasonal basis. And then the VIX, quite often seasonally, will have a tendency to go up from here, which means stocks are usually going down. The SKU index, it did drop down, but we're still in this red area where the market is anticipating some kind of a big move. We're no longer extreme here. We're just a little bit below the dash line when we look at the VIX to S&P 500 correlation. We had climbed above it after Friday. And that's when you could kind of look at this as the VIX getting kind of high right here. Well, we dropped down enough so that we're no longer getting that extreme reading. The equity put call ratio did decline on Monday, but our 5 period is going up, but our 10 period is still going down. The volatility risk premium ticked back up a little bit. It has really come down from these really high levels that we had been seeing, but it's still giving us a high overall reading itself. We went up with this fear gauge. We declined with the other fear gauge. I'm keeping an eye on this too, even though this looks to be improving still. It's the spread between risky and not as risky bonds. This is a long-term chart. And we base that around the VIX as well, where the VIX is still, even though it's going up a little bit, it's still giving us very low readings. And then to kind of break that out, and I went over this over the weekend, we're looking at the S&P on top. This is that same chart, but inverted. As long as this is going up, that's more positive for the market. And then the VIX is actually going down a little bit, which means it's going up because this is an inverted scale, but still giving us very low readings. We look at the risk on to risk off ratio. It was up just slightly, not really breaking out of this range, but we have been going up lately as folks are preferring stocks over the more conservative stocks, or the riskier stocks over the more conservative stocks. We're still seeing an improvement here. The advanced decline line based on price, we're breaking out above this previous range and looking pretty solid there. We're also looking pretty solid based on volume. We saw another thrust up with the new highs. Not really doing enough here to change our 5 period, but our 10 period continues to go up. And we're looking good here with the advanced decline ratio, both in the short and intermediate term. And then we're starting to still be a little far away, which is kind of strange because it looks like we're not that far away when you look here at the chart. But according to the boom indicator, we're still a little extreme from this moving average itself. If this continues to come down, that's going to cause us even more concern. Then this is also a concern. We're going up with the S&P and the Chaikin money flow is going down and the red line's going down. And we're also almost ready to turn negative with the Chaikin oscillator. And this is another smart money indicator. Okay, I'm going to take a pause right here and close the window because now the noise is getting unbearable and I don't want to start recording this video again. So just sing a song or do a dance until I come back from shutting the window. Okay, here we go. You gotta love these take one videos. Nothing like a live performance here. Looking at the NYSE cumulative advanced decline line, we're looking solid there, really going up. We're also showing a lot of improvement with the regular NYSE advanced decline line. Also still going up with the other NYSE advanced decline line. We're going up with the common stock based on price, but we have not surpassed this previous high. We are still breaking out based on volume, and volume tends to be leading price right now, at least in the broader market sense. And then going up here with we finally broke out with the S&P cumulative advanced decline line based on price, but looking even more solid when we look at this based on volume. And so, I mean, the S&P is still hanging together, but it's not the really big stocks that are really having the impact right now. It's the rest of the stocks in the S&P that are keeping it more solid. And we are still seeing an improvement here with the S&P to the NYSE advanced decline line. The red line is going up and actually matching what the bar chart is doing, even though they're on different scales. So we're seeing pretty much nice solid improvement here with our advanced decline line studies for the NYSE common stock, the S&P, the mid caps, and especially the small caps. On a short-term basis, we're still above this pivot point. If we continue to go up, we do have overhead resistance at other pivot points. We drop to below average based on volume. The Williams percent are still extreme positive. We're coming down, but the CCI 14 is still extreme, as is the CCI 20, even though it's declining. We're extreme in the short-term stochastics, declining and just barely hanging on to being extreme in the intermediate term. Rolling over a bit here with the long short-term stochastic, but still extreme positive. On a trending basis, we're still looking really good though, because the S&P continues to go up. We have a series of higher highs here and higher lows, at least as it looks right here, and the lines are going up themselves. We're no longer extreme with the 20 period moving average here. We were flat with the 50, but we're still going up with the 200. The force index continues to be positive, and we're still above the plotted moving averages here based on 20 periods, this is still looking really solid in the short term. But we're up into the +3 channel with our standard deviations chart. We are extreme here with the boom indicator. We're getting kind of far away from that 20, and we're also far away from the 50. We actually ticked down a little bit, but we've been showing overall improvement with the distance away from the 200 period moving average. Intermediate term going up and above zero with the balance of power. We're also positive on a trending basis with the go, no-go system. We're looking good with the highest high value. The TTM squeeze, though, is still not all that convinced. It has the darker blue, and it's actually been sideways to slightly down on a momentum basis. But our 50 period moving average is still looking good. We're above both the red line and the blue line. We're going up with the ease of movement. The Erin is actually working off of this extreme positive reading. And we came down, but we're still extreme with the S&P McClellan oscillator. So since we're above zero with the McClellan oscillator, we're going up based on price, and we're looking even stronger based on volume. We did tick down, but we're positive with the NYSE McClellan oscillator. So we're going back up based on price and volume for the NYSE summation index. The Swenlin trading oscillator, it's looking more positive based on price. It actually is it's still going up, but it really slowed down here based on volume. And our momentum is positive with the PMO, but it's above this red line. Price is going back up and volume is also going back up. We're no longer extreme with the PMOs that are rising. It actually ticked down a little bit. We're still going up, but maybe slowing down with the buy signals, but we continue to go up with the PMOs that are above zero. We have gone from being neutral to positive with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR. We're trying to go back up here with the slope oscillator, but it's pretty much been going sideways. The MACD is above its moving average, even though it's starting to go sideways as well. So we're trying to see an improvement in the short term, but you see where the TSI is actually rolling over a bit. That's short term. We're in the intermediate term. We're still above the moving averages. The long term, the TRIX is looking okay, but we're kind of going sideways on top of the moving average with the KST. So we're not seeing across the board strength right now. But this is across the board strength. We're above all of these moving averages on this chart. And this is also encouraging. The bullish percent index, that's showing that more stocks inside the S&P are generating point and figure buy signals. And this continues to go up, and that is encouraging. And we're going up with the NYSE bullish percent index as well as the NASDAQ 100 bullish percent index. So that is an encouraging sign. The money flow is positive. The ultimate oscillator is still declining. Not really quite sure what's going on there. And we're seeing a bit of an improvement here with the vortex. After a couple of sideways days, it's finally seeing the green line going back up. The RSI based on 14 and 9 continue to be extreme positive. On balance volume is positive. We're coming down a little bit here, but we're above the moving average when we look at standard deviation, which is trying to measure the speed of how fast the S&P is moving, not the direction, but just the speed. And we came down after really looking pretty extreme here with those stocks in the S&P above their 20 period moving average, but this is still looking much better than it had been. And so we're coming down after getting above 70 here. We're wondering if this nice little secondary upthrust after we saw the one coming up out of the April to May lows here, if that's really going to help the S&P continue to go up. We ticked down, but we're still positive with those stocks above their 50-day moving average. And we're flattening out with those stocks above their 100-day moving average and flattening out with those stocks above their 200-day moving average. So not an awful lot of strength. It's not necessarily a concern based on this. What's concerning more to me is our smart money indicators are showing some weakness, and we're seeing this late day selling that isn't being accompanied by a lot of late day buying. That's what I'm kind of seeing right now. The Copic curve is trying to turn back positive on a momentum basis. We're still extreme, even though we're flat with the Sean trend meter. We're still looking pretty extreme when we measure the 50-day rate of change. We're above this red line. We're looking good here, though, with the Amex, NASDAQ, and NYSE, the 5-period moving average of the highs minus the lows. They continue to improve. That's suggesting broad market improvement. And then we're starting the 5th week now of potentially being above this R2 level. And we're coming up to the 61.8% extension here for the fib level. We got above it, but then we weren't able to stay above that on Monday. And then our different charts, the trend is still looking really good here. The trend is your friend until the end. Heiken Ashi is positive. The Kegi is positive. The Renko is positive. The 3-line break is positive. And we're extreme when we get above this red line with the 200-day moving average, even though it was flat. We were flat with the 150, and we have not quite become extreme, at least yet. The rate of change going back 200 periods, much longer term, starting to go above this blue line, could be something just for us to pay attention to. We're positive on all the different time frames across all the different indexes according to the Keller market model. We're still negative in the long term with bonds. We're negative in the short term with commodities and the dollar, and now we've even switched over to an intermediate term downtrend with the dollar. We're still looking positive across the board with the decision points scorecard. Everything is blue or green on Monday. Just happy, happy day. Even though we saw some selling, we did get it back above 5,600 for the S&P. We set a 4-year all-time high, or no, new 4-year high. And we're seeing where the BPI for the financial sector crossed above 80. We're seeing a lot of bouncing up with the NASDAQ. Even Canada got in on it. Dow setting an all-time high. So, I mean, lots of positive things are happening, but we just want to be aware of those things that are concerning us. We saw energy, which had been kind of under some pressure lately. It did the best, followed by financials. And then the area that was the weakest were the utilities, at least in Monday's session. And we're still looking good here with the raw score of the new highs minus the new lows across the NYSE. And we're looking better here when we look at the S&P weighted index to the equal weight index. And so this ratio continues to come down. And that's not necessarily negative if you take it in the proper context. It just means more stocks are participating than just a few stocks and helping the market go higher. The Dow came up here and set an all-time high, but we still closed underneath this pivot point. We're positive with the diamonds. And we are still above this R1 level and looking okay here with the NASDAQ. We're also above this pivot point with the NASDAQ 100 and still looking pretty good there. But we're still neutral according to the Elder's Impulse system for the Qs. This is a concern too. We're seeing the momentum for the NASDAQ 100 cross below its moving average, and this is starting to go down. That's a bit of a warning sign to us. And we got almost up to this 50% extension with the Qs, and we have not been able to get back above that, at least yet. And then we're looking at this showing an improvement here, where the equal weight is not quite back to setting a new all-time high for the S&P, but we are setting all-time highs with the QQQ equal weight ETF. Small caps, but we've seen this before. Look at what happened back in November into December, just screaming to the upside. Everybody thought, okay, I'm sticking all my money in small caps and my retirement is going to be triple by the end of the year. And then boom, we go into this sideways trend. We're seeing another breakout here. This was the buzz concerning the stock market over the weekend. Small caps, small caps, small caps. Are we seeing a shift? Are we seeing a rotation? Well, maybe. It's looking good now, but we still need to see more of an improvement here. And we are positive with the Elder's Impulse system for the mid caps. Okay, what is going? Did I miss a chart? There should be a mid cap chart in here somewhere that I'm not seeing. Here's the mid cap chart. Also came up to this R2 level and then closed well off of the high. Okay, I got this out of order. Sorry. When we look at the Russell 2000 small caps, also showing some strength above its 50-day moving average, and the momentum is positive, but we're pretty extreme now with the RSI, which could, at least to this point, suggest good momentum. Now we go back over the mid-cap chart. Okay, the small caps continue to be positive. We are setting another new all-time high with the total U.S. stock ETF. Apple was up 1.67%. We have Tesla, which after pulling back down a little bit was up 1.78%. NVIDIA was down slightly. Microsoft was up barely. Meta was down a little over 0.5%. Amazon was down 0.91%. And Google was up 0.79%. You take all that together, and that's putting a little bit of upward thrust potential away for the S&P 500. Netflix was up 1.37% and bouncing off of its 50-day moving average. The FANG index was up but closed way down off of its high after setting an all-time high last week. The financial sector, this was strong, up 1.46%. That's good. for the market. We want the financial sector to do well if we're positive. We continue to decline, even though we bounced up a little bit with the staples to tech ratio. We want this to continue to decline to remain positive. The dollar, it was up, but now it's been seeing some recent weakness. And we look at the short-term correlation between the S&P and the world index, fairly strong on a short-term basis, starting to bottom out here on the longer-term relationship. And looking at the staples, they were down 0.58%, seeing a little bit of a weak period here with the momentum and relative strength of the S&P. Utilities, they were down 2.43%, coming back down to their 50-day moving average. Real estate, this is another area that's very heavily interest rate sensitive. We're seeing some improvement here in this area, and we want to keep an eye on healthcare because that's more of a defensive area. It was down 0.35%. We were up with the 10-year yield. We were down with the 10-year based on price. This is the area that we were watching before this even happened, where home construction to the 3 to 7 year bond ratio had come all the way down to its 250-day moving average and continue. It was unchanged on Monday. It's bouncing up off of that with this ratio. That's what we saw last October going into November, which led to a really nice upward move in the S&P going into the end of the year. We're also looking really solid here when the market is still anticipating that there will be a soft landing. And we're continuing to decline. This is an inverse of that chart we just looked at. This means that bonds are underperforming stocks, and we want that to continue to decline if we're positive. We look at the broad market, holding up well with short-term bonds. The broad market is also holding up better with little longer-term bonds. The Qs, even though they're coming back down to the top part of the rainbow, did tick up slightly when compared to 3 to 7 year bonds. And the tech sector, coming back down to the top end of the rainbow when also compared to the 3 to 7 year bonds. Not really seeing much improvement here with the growth to value ratios. Coming down to the moving average with the Qs to S&P, a little bit of a tick up above a tick down above the moving average with discretionary to the S&P. Large cap growth is coming back down to an advancing moving average when compared to large cap value. So the large caps coming down to their moving average, not really seeing an improvement with the mid caps or the small caps right now. Well, this is looking better. The 19-day advanced decline ratio continues to go up based on price and volume. The S&P to utilities ratio is going back up. That's positive. And we're seeing the 2-year yield coming down slightly, which often gives support to the S&P. And we're declining with the staples, the S&P 500 ratio, which also supports the S&P. Then we're dealing with this Hindenburg-Ullman. And if you're watching this for the first time and you don't know what that is, here is the definition. And if you're having trouble sleeping, please read this. You'll be out in a minute. This is the chart of what everything was said on that previous slide. We did get a signal on July 9th. Now we're waiting until August 2nd to see if we're going to get another spike up. That would be a confirmation. We have not seen that at least yet. We're actually coming down a little bit here with the NASDAQ, where we have seen a ton of confirmation signals for the NASDAQ, but it just kept going up after that. So what's our outlook then? We're positive from a technical basis, and the broader market is showing a lot of improvement. I am quite concerned now about this late day selling. Bank earnings, where we saw declines on Friday, we saw advances on Monday. We're going to get retail sales, a big major economic report. We're also going to get import and export prices as well as business inventories and the NAHB housing market index. And then we want to keep an eye on all the different crazy stuff going on in the world. And then on Wednesday, we're going to get industrial production and capacity utilization. Thursday, we're going to get LEI, and then jobless claims will probably be pretty important then too. And from what I could tell, there are no reports coming out on Friday. So here is what will be happening in Tuesday's session. Seasonally, we're neutral to negative across the board. Not strongly negative, but not really looking positive when we measure July 16th, at least recently. Well, we are now heading into options expiration, where we tend to be up just a little bit more than down. And we're not really seeing any edge as far as seasonality for the S&P during an election year. Tuesday's kind of indifferent as far as what happened in 2023, but we are still looking good when we take a little bit of a longer view of how things performed during an election year. And we're wondering, are we still in this NASDAQ second Christmas here? Or are we going to top out at some point and then see the NASDAQ start to pull back? At least that's historically what has happened from 1985 to 2023. And we do see things a little bit more choppy. That's the dark blue line here in July and into early August when it's an election year. We're also quite far away from these averages of seasonally what has happened. So there may be some justification for prices to revert back to the mean, which are these other lines that we see here. And we're starting to come out of the middle, we're coming up to the middle of July where we're getting out of the first half and starting to go into the second half. And we're also coming up, they have it happening in about the 17th. So that would be after Wednesday's session. Okay, so the late day selling, that is what I'm picking up for right now. Both on Friday and Monday, that is a concern. We're keeping an eye on these other defensive sectors, the growth of value, as well as discretionary to staples. And looking okay, but they're really not leading right now. The 5-day equity put call ratio is going up, and we're worried about the momentum for the NASDAQ 100 actually turning negative. Then we look at the positive side, the accumulation distribution, Chaikin money flow, and Chaikin oscillator. Yeah, they're positive. And the accumulation distribution is extreme, but we're seeing declining from these indicators, and it's not giving us an awful lot of confidence right now. The parabolic SAR is positive. Both the S&P and NYSE McClellan oscillators, as well as the summation indexes, are positive. We're still above 50 and looking better with the bullish percent index for the S&P. The Swenlin trading oscillator is positive, but that slowdown in volume, just a little bit of a concern there. The 10-day average of the equity put call ratio is still going down. The advanced decline lines are looking much better, and our oscillators are looking positive, but not really across the board right now. The Copic curve is looking more positive, and our 20, 50, 100, and 200 period moving average studies are improving, even though a lot of them ticked down or were sideways on Monday. The money flow, the ultimate oscillator, and the vortex continue to be positive. The bullish percent index for the NYSE is positive. The financial sector is really quite strong right now. And the bullish percent index for the NASDAQ 100 is looking positive. So our conclusion, we are positive. Internally inside the S&P, we're looking better. The broad market is also looking better, but this late day selling is a bit of a concern. We are still quite overbought or extreme positive in the short term. We're also becoming more overbought in the intermediate term, and this is where I'm focused more on that late day selling concern, where we're positive in the long term, but we're still seeing those negative divergences. However, there is an improvement with the 150 and 200-day moving averages. Thank you for putting up with my take one improv type session here. I hope you have a really good day, and I will talk to you in the next video.